In this module, now we're going to talk about cost behavior, and we're going to introduce a very important concept called contribution margin. The contribution margin is a very useful tool for managers. Now, it's so important that management understands costs. And in the next 3 modules, we're going to be analyzing costs and how we use that analysis to do profit planning, predict target net income and determine company's optimal cost structure in his first module, though we're gonna talk simply about cost behavior. First, we're going to distinguish between what is a variable cost and what is a fixed cost. Then we're going to introduce mixed costs and then the contribution margin to begin with. Cost behavior analysis is the study of how specific costs respond to changes in the level of business activity. Now, most of on that level of business activity is sales or production, but it can be other things. But some costs will change as sales increase or production increases and some will not, and the only which will increase and which will not help management plan operations in the future and also to decide between alternative courses of action. Now, this management tool applies to all types of businesses, okay, and it's very important in measuring business activity now. A cost behavior analysis, is expressed in terms of activity levels and the activity level, as they said before, it can be sales dollars or production, could also be miles driven, room occupancy at the local hotel and so on. But what we're doing here is we're going to look at the changes in the level or volume of activity and how those changes correlate with changes in costs. Now what we talk about activity. We're talking about an activity index, and we have to be very aware of what that activity index is. And according to that activity index, we will then be able to classify cost as variable or fixed or mixed. Now to begin with, a variable cost is a cost that varies in total directly and proportionally, with changes in the level of activity. For example, if the activity level like sales or production increases 10%, then that cost, if it's a variable, costs will also increase by 10%. If the activity level decreases 25%, the total variable costs will decrease 25%. Now that is the definition of a variable cost, but also notice that a variable costs will remain the same per unit at every level of activity. For example, let's assume I'm producing this desk, okay? And I'm looking at the cost of wood and I analyze it, and I see that the cost of wood is 50, and I say okay, if I produce one, what's the total cost of wood? 50. If I produce 2, what's the total cost? 100. If I produced 10, then the total cost of wood is 500. So it is, wood then, I say, is a variable cost. It changes in total in direct proportion to changes in the level of activity, so it's defined as a variable cost, but notice how it behaves. It remains the same per unit at every level of activity. That is, if I produce 1, the unit variable cost is 50. If I produce 2, the unit variable cost is 50. If I produce 500, the unit variable cost is 50. That is, you know the nature of a variable cost. An example. Here, Damon Company manufactures tablet computers that contain a $10 camera. The activity level is the number of tablets produced, and as it shows that at 0, production, 0 cost. But as production increases, the cost increases in direct proportion. So therefore, this illustration shows that the total cost of cameras will be 20,000 if they produce 2,000 tablets and 100,000 when they produce 10,000. Okay, we can see that the variable cost remains the same. So if we were to graph it on a unit basis, this is what it would look no matter what level of activity. The unit costs for camera is $10, and that's the nature of the variable costs. Graphed in total is directly proportional to changes in the level of activity. However, it remains the same on a per unit basis. It does not change now. Contrast that with a fixed cost. Of fixed cost remains the same in total, regardless of changes in the level of activity. However, on a unit basis, as fixed costs go up, the unit cost goes down. The per unit cost varies inversely with activity, as volume increases, unit cost declines and vice versa. Examples: property taxes. They do not change with production activity, needed assurance nor rent as the nature of a fixed cost. And if I was to graph it, and I'm looking at Damon Company, they have production facilities, and it cost him $10,000 per month. So the total facilities will remain constant okay at every level of activity. However, on a unit basis, Damon Company leases its productive at 10,000 per month. The total fixed costs of the facilities will remain constant at every level of activity. But on a per unit basis, it goes down. That is to say, if I produced one desk, let's say or camera, it would be 10,000 by produced 2 well. It would be 5,000 per unit if I produced 10 and to be 1,000 per unit. So you see the fixed cars varies. Inversely goes down per unit as production increases. That's a very important to understand that, and to graphic, you see total fixed costs remain the same, but unit costs decrease. But there's a limit to that, and that's called the relevant range. And when we're talking about fixed costs, we must always assume that that cost behavior is constant within a relevant range of activity. For example, if I'm producing desks in a particular factory and the rent is 10,000, well, I can produce probably up to 500 desks in that factory. Each month now, if I want to produce 600, I can't. I'm at the limit of my capacity. I have to add capacity. So I say the relevant range of activity when I talk fixed cost is between 1 and 500. Once I go outside that relevant range, then the fixed costs will jump. I cannot add fixed costs proportionally. I have to add basically in chunks, and so therefore you can see here on the right total fixed costs up to a certain point, and then it jumps. And that's why management, when they're always planning in the future, they don't plan for the capacity they're doing now. They plan for the capacity they think they'll be doing in 5 years, so they always add more capacity. Then they need because of this idea of the relevant range of production. And so that's how that works. It works. Total cost is like a step function on the right-hand side, up to a point, and then you jump up and a relevant range thing goes up past 80. Then it jumps again up past 100. Okay, now there's a third category of costs and that are termed mixed cost. That is, they are both variable, and they are very fixed. That is, this cost changes, but it doesn't change in direct proportion with changes in level activities. So it's not a complete variable costs, and the fact that it changes means that it's not a fixed cost. So it is a mixed cost, partially fixed and partially variable. Now we cannot work with a mixed C cost. We have to break into its fixed portion, and its variable portion. Identifying a mixed cost is very important here. We have production level or no cost to levels of production, 10,000 units and 20,000 units, and we have direct materials now known as direct materials as variable. Why? Because at 10,000 units it's $20,000. If I double the production to 20,000 units, the cost goes to 40. So it's a variable cost in various indirect proportion. Double the production, double the cost. The next cost is maintenance. Now it's 8,000 at 10,000 units. We double the units, it changes, but it doesn't change, doesn't double. It increases to 10,000. It increases because it's partially variable and the fixed partial remains fixed. Indirect labor obviously is variable. Indirect materials is variable. Depreciation is 4,000 and 10,000 units, $4,000. It's also 4,000 and 20,000 units. So you see, it's a mixed cost. Now how do we break out a mixed cost? Well, we use what's called the HiLo method. We can classify the variable cost. The slope of the line, the fixed, is 10,100. We track the cost activity over a particular period of time, and we select the high level of activity and the low level. And we look at the costs at the high and the low. And we know that the difference between the high and the low is the variable costs, because that's the only cost that changed. So therefore, our formula here is to look at the change in total cost between the high and the low and divide that by the high minus the low activity level, and that gives us the variable costs per unit. For example, here we have Metro Transit Company as the following maintenance costs. Mileage data, there you have 6 months. January, February, March, April, May and June. You have the miles driven in January 20,000. Total cost $30,000. February double the miles 40,000, but not double the costs. That's why this is a mixed cost. So we look at the activity and we take the low activity, which is 20,000. And the high activity is April 50,000 miles, $63,000. So we take the changing cost as the numerator. That is 63,000 minus 30,000 or 33,000. And we take as a denominator the change in activity, and that is 30,000 miles. So we come up with a $10 costs per unit. Now we know the variable cost per unit is a $10. So we go back to the high level. The total cost, which is 63,000, is partly variable and partly fixed. So let's figure out the variable portion. We know at 63,000, they traveled 50,000 miles, so the variable portion of that, 63,000, is 50,000 times a $10 or 55,000. So that is the variable portion of the 63. Obviously, the fixed portion is 8 and fixed is fixed at all levels. So let's go look at the loan at the low. The total cross is 30,000. They traveled 20,000 miles or kilometers, and we get 110 mile or kilometer. We had 22,000, so therefore the fixed cost is 8,000. So we know that the fixed class is 8 and the variable causes a $10 for change in activity miles. So maintenance costs, therefore, is 8,000 per month plus a $10 per mile. So I can predict what my total maintenance costs roughly would be. Let's say if I travel 45,000 miles, the fixed cost would be 8,000, the variable would be a 1.10 times 45 or 49,005. So that's how we break out a mixed cost into the high and the low. If you want to see it visually, there it is craft for you. Okay, now, here's another very, very important management technique. Now that we know which expenses on my income statement are variable and which expenses on my income statement are fixed, we can rearrange the financial statement, because you see, this financial statement prepared by the accountant was prepared according to generally accepted accounting principles, that is, sales 800,000, cost of goods sold by 20, gross profit less operating expenses, net income. But for management accountant for managers, this statement is not very useful. Now I know the cost of goods sold. Part of that is fixed, and part of it is variable. I know the selling and admitted expenses. Some are fixed and some are variable. So what I do is I reformat. I don't change. I just reorganize the expenses into those that are variable and those that are fixed. And here's an example. Vargo video, the same number of sales 800. But now I know the variable cost of goods sold was 400 and this variable selling expenses for 60 and administration is 20. So the total variable costs of making sales of 800,000 is 480,000. The fixed cost down below, contribution cost of goods sold 120, selling 40 men. 40. The total fix is 200. My net income is the hunter. Well, now that I broke my expenses into variable and fixed, I'm able to introduce a new concept here. Now I know variable costs varies in direct proportion to sales. His sales, who is up 10%, variable costs, go up 10%. So what I do is, because they vary in direct proportion, I met them together. I take the sales minus the variable class, and I have a new line called the contribution margin. Now that contribution margin is the sales minus a variable cost, or the excess sales after I cover my variable costs. Now that's not profit, because I now have to cover my fixed. So I have contribution margin of 320 that contributes to cover in my fix. Once I cover my fix 200, the rest is profit. So now you see, by rearranging this statement into what's called a cost law and profit income statement, or CBP, I now have a way of predicting what's going to happen to my profit if I increase sales 10%. Very Makosco up 10. The contribution margin will go up 10. But the fix will not change, and I can determine my profit. So you have a new concept here. Contribution margin. And when I just take contribution margin, I mean in total as 320. Now I can go one step further. I can break this into units. I can look at what's called the contribution margin per unit, as sales is 500 per unit. So when I make a sale, income's $500, I have to set aside 300 to cover my variable costs, which leaves me with 200. And that 200 then contributes to my fixed costs. So that's another way of looking at an income statement. Again, the same numbers basically, and you have the CVP statement for Vargo. Now, the contribution margin per unit. The unit selling price minus the unit variable costs, gives us a contribution margin. Per unit. If I looked at my statement that 200 every unit, I sound like a contribution margin per unit of 200 now that has to cover my fixed costs. My fixed costs are 200,000. So to break even, I have to figure out how many units I need to sell. I simply divide contribution margin per unit into the fixed costs, and I get 1,000 camcorders. So this called my break-even point. And the next unit I sell after I break you the contribution margin that I earned on that unit. I sell it for 503,100 set aside to cover my cost 200 contribution margin, but I no longer needed to cover my fix. Therefore, the 200 is profit. I also can turn this into a contribution margin ratio. Now, anytime you hear ratio, it always means a percent of total sales or selling price. So when they say contribution margin ratio, it's the contribution margin as a percentage of sales, the contribution margin is 200. Sales is 500. Therefore, my contribution margin ratio is 40% if my contribution margin ratio is 40%. Sales or sell MG price is 100%. The variable cost ratio. The complement, 60% of the contribution margin ratio. 40%. So the contribution margin ratio is 40. The variable cost ratio is 60. They have to add up to 1 unheard. We have variable costs. Fixed costs. You should know how to break mixed cost into its fixed and variable, know how to reformat a financial income statement into a class volume, profit income statement. Understand the terms, contribution, margin per unit and contribution margin ratio.